All right, everyone. Good afternoon. Thank you for joining us today for our webinar, Don't Sell Yourself Short, where we have a panel of experts that are going to weigh in on ongoing consolidation, in the cannabis sector, and how buyers and sellers should be thinking about some of the most relevant issues. My name is Steve Miles. I'm the CEO of Sharp Capital. We are a recently formed boutique investment banking firm focused exclusively on the cannabis sector. We are an affiliate of Livingstone Partners, which is a firm that I co-founded that does about 50 to 60 transactions per year. The vast majority of those are representing sellers of businesses and in private sale transactions. And we have been watching with great interest the ongoing consolidation that's going on in the cannabis sector and how it might differ from more mature industries. And we have assembled a great panel, starting with Joe Caltabiano, who's a co-founder of Cresco, Greg Chin, who's a partner at CohnRezhnik, focused exclusively on the cannabis sector, and Michael Schwamm, a partner with Duane Morris, who again, a firm very active in the cannabis sector, and Michael spends all of his time in the sector. So we're going to run through some topics, but this is meant to be for the audience. We want to answer the questions that are most important to you. So please feel free to ask questions. There apparently is a button at the bottom of your page that allows you to submit questions. And when we get to the end of the presentation, we'll do our best to answer those questions. So without further ado, I would like each of my panelists to introduce themselves. And why don't we start with Joe?
Hi, everybody. Joe Caltabiano, co-founder of Cresco Labs, was the operating president up until this year at March of 2013. Came from the regulated mortgage banking space prior to cannabis, but been involved in the industry since 2013. Now looking at a multitude of opportunities within the space, and excited to be a part of the panel. So thanks for having me, Steve.
Thank you, Joe. Greg?
Thanks, Steve. Good afternoon, everyone. My name is Greg Chin. I'm a partner with CohnRezhnik. We're a full-service CPA firm providing audit, tax, and consulting services to the industry. My practice area is doing due diligence for buyers and sellers of businesses, and I focus on the cannabis industry, representing MSOs and cannabis funds as they've been deploying capital into this sector. Happy to be here. Thank you.
Great. Thank you. And Michael? I think you might be on mute.
Yep, here we go. Thank you, Steve, and pleasure to be with these such a wonderful panel. Duane Morris is a national law firm of about 850 lawyers, full service, handling all the legal disciplines that you would expect. I'm in the corporate group. I do mainly, M&A and assisting companies raising private capital, as well as general corporate advisory. And while it seems some days that I'm spending 100% of my time, it's probably only about 50, but it certainly is the industry, by a large amount, where I'm doing deals and just general corporate work.
Great. Well, thank you all for doing this. You guys are clearly experts, and it's nice of you to spend some time educating all of us with your vast experience in the sector. So let's jump right into it. Why is consolidation occurring? It seems that there have been some big deals announced in the past couple of days that we are going to talk about, but it seems to us here at Sharp that you have these mature markets like the Colorados and the Oregons that are consolidating for very different reasons than the factors that are driving M&A activity in more nascent markets or transitioning markets such as Illinois and New Jersey and Pennsylvania and Ohio. So can I just get your perspective and maybe start with Joe on this as a buyer of these types of assets? What's driving all the activity, and do you think it's a trend that's going to continue for the foreseeable future?
Sure, thanks. So, obviously you have to divide up the country into a few different categories, as you mentioned. The more mature markets with more of a unlimited license structure, and then more of the nascent markets that have a limited license nature to them. As a general statement, the more mature markets typically have seen some level of price compression that you're now selling cannabis at a much lower price than you were when it was a little bit newer or less operators were in the space. So what ultimately happens is people look to divest some of those assets because they can't achieve the operational scale that somebody who has 10, 15, 20, 50 stores can achieve, as margins start becoming a real driver of the value of your business or the long-term staying power of your business. The opposite is true in the newer markets where you have a limited supply, but there's an incredible capital need to build out 20, 30, 50, 100, 200,000 square feet of indoor grows. And that capital at $250 a square foot, you're starting to stare down a $20 to $100 million capital raise that's sometimes unattainable for a lot of these operators. So that makes them start to look at other opportunities of divesting assets or partnering, being a part of a bigger operator who does have some operational scale and the ability to raise a significant amount of capital, because you need such a huge amount of supply in those markets, and you know the supply demand ratio will be out of whack for some time to come. But if you can't put the money behind it, you're not really going to get full potential of that asset.
Yeah, that's a great point. I'd like to ask Michael about that as well. I mean, we are just seeing so many opportunities with groups that have achieved licenses, but are out there trying to raise the capital now that they have the licenses, and are finding difficulty raising the capital, particularly if they're not already an experienced operator. Is M&A a way to solve for that?
I mean, absolutely. I mean, much like Joe said, I think there are a bunch of different things going on, right? There are, companies out there, that actually are operating, but cash is scarce, and they frankly don't have enough capital runway to continue for the foreseeable future. And so, really their only option is to shut the doors, which, nobody wants to see happen, or, sell out at a distressed or quasi-distressed basis. But likewise, if all you have is the license and you have no prior experience, trying to find capital has been extremely difficult, and it's probably been that way for the last 6 months to a year. We are, seeing, and sort of an uptick in business plans, from people who sort of had that premise, like, if I build it, they will come. So I got my license now, give me 40 million bucks so I can build it out in some combination of debt and equity. And those are just not getting funded, to be completely honest.
Right. So it sounds like you have consolidation going on in more mature markets, that Joe points out, because the supply demand imbalances, and it becomes about being the most efficient operators. You have M&A activity in the nascent markets because of this massive capital need. Ultimately, the nascent markets will become mature markets, and then that M&A activity, and round we go. So this is going to be a very active market for a long time. So Greg, your firm is involved in so many of these transactions on the accounting side. Can we talk, who are you seeing as the real active buyers right now and for the foreseeable future?
Yeah, with our client base, it's been a mixed bag, but largely led by MSOs that are trying to fill out portfolios in selected markets. And then the other buyers that we're seeing are cannabis private equity funds that are also targeting selected markets. And then kind of filling in behind there, we've seen an emergence of debt capital enter. So, they're not acquisitions, but they are a form of capital that's helping to grow the industry.
And Joe, talk to us about the public MSOs versus the private MSOs. Is one a better buyer set than the other? Generally, do they view the world differently? Should sellers think about them differently, or are they just effectively the same animal with different stripes?
Well, most of the public MSOs are exactly that. They're publicly traded companies. They have a multitude of financial obligation and reporting obligations. So doing a transaction with them is much more open. It's an open kimono when you're doing a transaction with a publicly traded company. So they certainly have more boxes to check. It's a much more thorough process. The private MSOs, can navigate typically a little bit quicker. There may not be shareholder votes to the extent that you have with some of the public transactions, but they both want the same thing. They're both trying to really build out businesses that are now focused on EBITDA positive, EBITDA multiples, free cash flow, and things that are trying to normalize this industry. So what we're seeing is the MSO's level of sophistication is rising very rapidly, and the sellers of their one store operation or one grow operation need to also rise, because the sophistication of the buyers is going to continue to increase as they're getting more reputable law firms, more reputable audit firms, more reputable bankers involved. The processes are going to continue to get more and more structured. So, as a seller in the space, they're going to operate very similarly, but certainly the public company, you're going to see disclosures come out quicker. You're going to see, once signed LOIs are done, there's an obligation of reporting that you may not otherwise have. So as a private seller of a company, sometimes you have things you want to keep close to your vest. And some of those things, for better or worse, or for whatever reason, it's going to come out much quicker in a public transaction.
Yeah, that's interesting. I also thought it was interesting, the point that you made to me the other day, that even the large private MSOs all plan to go public in the next 12 months anyway. So they're kind of starting to behave as though they're already public. And so you're still going to have kind of the same level of scrutiny that with a public, perhaps with a private company buyer, that you would otherwise have with a public company buyer.
Absolutely. You're going to see, the rush you see in cannabis, especially the transition from private to public really occurs in waves and tranches. And you'll see, much like when Cresco went public at the end of 2018, there was a multitude of companies that went public in the third or fourth quarter of 2018. I think the same is going to be true, where you're going to see a significant amount of public opportunities in the first quarter, second quarter of this coming year. So you'll see this transition, and everyone positioning themselves to operate in the most amount of transparency, what's in the best interest of shareholders, and really try to act as if they're public along the way.
Yeah, I mean, I think one thing that's very interesting about this market, unlike any other, is nobody in this industry is building a business to pass on to their kids, right? It's all to build it, to sell it to somebody, and it's either if you're small, sell it to a private MSO. If you're a private MSO, it's to sell it or go public, or wait a couple more years, and when Coke, Pepsi, P&G, and everybody else comes into the market, they'll buy you. But it's not with the possible exception, as someone pointed out to me, of some of the the farming businesses in the West Coast where they're using this way to get their kids back to be farmers. It's not that kind of business.
Yeah, for sure.
And adding to what Joe and Michael have said, a lot of the companies that we've come across and work with, while they're still private, have been preparing to go public, converting their books to IFRS so that they're ready when it's time to list on the CSE. So while that we did see a bit of a pause in there, I think it's still part of the plan for most of these companies that we've seen.
For sure. And Joe, talk a bit, just a minute, about the Verano AltMed deal that was announced yesterday. Is this the type of transaction we should expect to see the larger private or public MSOs pursuing?
Yeah, I mean, at first, I think it's a fantastic transaction. I've been up close and personal with Verano. They operated in a lot of the same states that we did at Cresco, and think very highly of them. And certainly AltMed has done a really good job of positioning themselves in a Florida market that is just continuing to have its foot on the gas, and then also very excited for their opportunity in Arizona, where they also are. So, I think large scale M&A transactions are going to continue to occur. There's only so many slots to go public. And it's not that everybody really couldn't get there. It's just there's only so many auditors. There's only so many legal firms. There's only so many opportunities. So some of these marriages will ultimately occur because you ultimately want the biggest scale you can that's manageable as you go public. I think we all believe that as big capital, and you mentioned the P&Gs and Pepsis and Cokes and private equity funds, as they ultimately dump into this space, that money is going to go to the larger operators who have achieved operational scale, who aren't trying to now put together their management team. So some of this consolidation of cash flow positive, good stewards of capital that see the world in the same place, but recognize that they're not going to get there fast enough on their own, create some of these opportunities. So I think this transaction will be very positive. I think you'll see, certainly that's teed up to become a public MSO, in my opinion. And I think they'll sit in some of the top echelon of the MSOs.
And hopefully Department of Justice will, not, start doing all these inquiries like we saw, I guess, a year or two ago, when, all of a sudden we're getting these cannabis, MSO mergers, and they were getting bizarre and overwhelming requests, for antitrust violations. Hopefully hopefully they just wanted to be learning. I mean, my take was, it was the easiest way they could to understand the industry, and went about it that way, but we'll see.
Yeah, having been a part of that, certainly it was a somewhat of a fishing expedition, but the DOJ's got some other things they're working on it, as I read.
Yeah. That's so we've talked about the types of buyers and why they're buying. Greg, if you take the recent transaction, I think today announced of Air buying Oasis in Arizona, it was, I think, an $80 million deal, but a 30 million in cash and 30 in earnout and 30 in stock, or something along those lines. Is that what sellers should expect in terms of transaction structure? A lot of very little of the consideration in the form of actual cash. Actually, I think that was 10 million cash at close.
Yeah, I think we're still going to continue to see a high proportion of the consideration be in equity, particularly, obviously if it's an MSO to MSO transaction, just because MSO is going to be using their stock to do the deal. But we have seen some deals, and I worked on one recently where it was essentially an all cash transaction, but for the most part, we're still seeing a high mix of stock.
Yeah, Joe, you always point out that in this industry, sellers should not be thinking of a sale as the end of a new beginning or the beginning of a new end. They're going to be in the seat for a while in some way, shape, or form. Yeah.
Yeah, it's this industry, listen, it sits federally illegally, as we all know, and I think many of you that are listening recognize. So you're not getting lines of credit from JP Morgan to run operational capital. You're not getting debt to build out your facility. So cash comes in waves in industries like this. In such a nascent industry, you either are long on cash or you're not long on cash. And I think, speaking from the MSO standpoint, if you have a good sized war chest, you're not going to just deploy that against the acquisition of an underdeveloped asset or an asset that helps achieve some further success for you. You need that cash either to operationalize your current asset, deploy it into markets that you're seeing the largest return on invested capital. So you can't just spend all of your money on buying some of these companies. There's such a huge need for cash, even though we are starting to see, some of these companies turn to positive cash flow on their earnings releases. There's still not enough free flowing cash to sustain growth along the way, that they need raised capital to do some of that stuff. So I think buyers should be recognizing that they're going to be part of a bigger entity and need to position a company in a very good spot that is accretive to the buyer. And then you see that stock continue to trend in the right direction. So I think a target for somebody is maybe a 50-50 mix. Maybe some earnouts come into play. Maybe there's some levers that go along with that. But I think that's a realistic target for a lot of sellers to start to wrap their mind around, and then kind of go from there and negotiate from there.
Yeah, and the one thing I would add to that is, I think you have to look behind the stockholders of the seller. In certain instances, in fact, they prefer equity in the combined company rather than cash, right? If they're a fund, that came in and it's now a slight distressed or highly distressed situation where it's effectively a down round, they don't want to have to recognize a loss on their investment, and give up all opportunity for any upside. And so, they will push, as we've seen in a number of deals we've done, to have it as a pure equity for equity exchange, so that their hope, if they've picked the right horse to run with, that at some point down the road in the future, they'll actually recognize a gain on their investment.
Yeah, that's such a great point. You could envision scenarios where investors are taking a lower price in order to get stock that they can mark and believe has upside potential. And then you have, I think probably Joe's point would be that sometimes a buyer can pay more if the seller is willing to take more stock. So things are, it's very, it's quite nuanced. So for the whole panel, if we have people in the audience that are sitting on a, vertical business in Colorado, or a dispensary in Illinois, or a license in New Jersey, are there standard valuation metrics in this industry that would, as they contemplate monetization, that will help them kind of ring fence what they can expect out of one of these transactions? We heard, 50-50, maybe cash versus other consideration, but how about just valuation in general?
Steve, before we hop to that topic, did you want to discuss SPACs at all, or hold that for another day?
Oh, we can. Why don't we just run down this lane for a minute?
Okay.
Yeah, I'll jump in first, and then I'm sure my fellow panelists have some views on this. But from what we've seen, there has not been any kind of uniformity from a valuation standpoint in terms of a multiple of revenue or a multiple of EBITDA. We're finding that it's very state specific, market specific, and also really kind of a negotiated price between buyer and seller, depending on who the buyer is and what their need is to kind of fill out their portfolio. So certainly we see like limited license markets, the valuation is obviously going to be higher than in the mature competitive markets. We have not seen within the last couple of years revenue multiples. We are seeing more of a kind of return to a more traditional valuation metrics. So the deals that we've been working on, we're always kind of running through and grinding on EBITDA. So we know that's factoring into valuations, but it's not, the only factor that's leading into a negotiated price.
Yeah, I mean, and what I would add to what Greg has so elegantly stated is, if you take a step back and look at this industry, it still is very new. And if you compare it to other industries that were new, I think the internet business back in the day, perfect example, when there wasn't enough information, data, you name it, to really value them. They were doing it based on eyeballs on websites, and that only lasted so long until people began to realize that there was no correlation between that and ultimately what businesses get valued on, which is free cash flow, EBITDA, or something. Because if these businesses are not making money, then then and never will, then ultimately there's not a whole lot of value there in the long term. And so I think this industry will slowly progress towards that. But when you have an industry where most of the participants, at least until recently, were EBITDA negative, you're sort of left with what should we value them on? And obviously revenue is one of the easier things to look at.
Yeah, I remember 3 years ago when I was first looking at this industry and all the Canadian companies, and everybody was trying to equate their value to how much cultivation square footage they had.
Yeah. Right, you pick something. Yeah.
Apparently, they weren't very correlated in the final.
Yeah.
I would add, and both my colleagues have made some great points. I would also add, it's to draw a line to baseball. If the Yankees and the Dodgers are looking for starting pitching, typically the value of your asset's a little bit higher. So, what you've got to recognize, especially in the limited license markets, is some of these operators are no longer buyers. They have the maximum number of licenses that are allowed in those states. So that is going to impact what your ultimate selling price can be, and will indeed impact, what the market value is at, because there's only so many people who have enough stock or liquidity that somebody's going to want their paper. B, there's enough cash to go around. So, as a seller preparing to sell, you've got to, it's incumbent upon you to recognize who ultimately could be your buyer. Would you want their stock? And then realistically, are they going to have the amount of cash that you're going to want or desire to engage in a transaction? Because as this continues to expand, you may see more licenses come out. Time is against some of the sellers in certain scenarios in certain states right now. Even though they are incredibly valuable and going to be cash flowing assets, they may turn into those generational assets if people don't seize the moment when that time is right and the buyers are really there.
Yeah.
Joe, that's such a good point. And I don't think anywhere is it more true that beauty is in the eye of the beholder. If you're going to sell, in the absence of private equity, in the absence of that type of outlet valve, you're going to be selling to a strategic buyer, and you should map the industry and really understand who most is going to benefit from the acquisition of your asset, particularly if you're going to take some of their equity in the form of consideration, that 1 + 1 = 3, as opposed to 1 + 1 is 1.5.
Yeah.
Uh,
Also don't assume that just because it's a limited license state now, that the license cap won't increase, right? If you look historically across, regulated businesses, they may start with, a limited number, but it somehow always seems to grow. And, probably the no better example than the New York City taxi medallion business, right? Where, it was limited and the things are worth, millions of dollars, and then they granted more, they dropped the price. And then something, else came along, i.e. Uber, and drove it, almost nothing. So,
well, as a sell side advisor, Michael, we're not going to lead with that point.
yeah.
So,
Well, no, but I mean, the point is that, the time to sell is, might be now.
Right. Exactly.
Yeah. So
that's a great point. Greg, let's move to preparing for sale. So the company's decided it wants to sell. It has thought about who the right buyers might be. Hopefully they've hired somebody like Sharp Capital to advise them. Insert shameless plug. But what else do they need to be thinking about? What should they do prior to entering into what are generally considered pretty arduous processes?
Yeah, so, if I were advising a potential seller, I would have told them this 2 years ago, right? At least 2 years ago. Start to run your business as if you were a non-cannabis business in terms of having your books buttoned up, having good financial controls and processes, having good management team. I mean, these are all issues that we run into when we're on the buy side in terms of companies' lack of readiness. They're not closing their books on a timely basis, or maybe only doing it at year end. So, in a perfect world, they would have been running their business well prior to thinking about a transaction. But if they're in the midst of coming to market now and haven't done all of these things that we're recommending, then, it's a matter of preparing yourself for a buy-side due diligence process. So obviously engaging advisors like Sharp, but also other advisors like good legal counsel, good accountants who can guide you through the process. We're a firm that does a ton of sell-side due diligence outside of cannabis. We don't see this in cannabis yet, but these are things that you can do to prepare your company to prevent value leakage, but also to help you withstand a process. One of the biggest issues that we see is processes being drawn out because a company isn't ready. And as everybody knows on this call, like, time is your enemy on a deal. And so the more time that it takes to get a deal done, more can go wrong. And we've seen a ton of deals that just drag on and eventually don't come to fruition because the process is dragged out and issues weren't covered during that diligence process. So I'd say, make sure you're buttoned up. If you've had the opportunity to get an audit done, that's great. It's not absolutely necessary. From a buy side, we can certainly do diligence without an audit having been done. But in a lot of cases, particularly depending on the size of the transaction and who your buyer is, an audit may need to be done down the road. So it's probably something you should be thinking about to at least be audit ready.
Yeah. So put yourself in the buyer's shoes and think about the diligence that's going to need to be done, and try to self-diagnose issues before getting into it. Michael, you want to weigh in on this from the legal perspective?
yeah, absolutely. I mean, my advice, to all the sellers out there who are first-time sellers is, start planning early. You can't possibly imagine the amount of time it takes to actually go through this process, and particularly in the cannabis space where management teams tend to be a bit leaner. It's essentially a full-time job, and if you have to spend your entire day on the sale process, your business is going to suffer. And if the deal doesn't happen, you'll be worse off. But as you go through the period of the sale process, which can be lengthy here, if your earnings start to dip, you're going to have buyers coming back to you and saying, maybe we have a material change here and we have to now renegotiate the price. So as Greg said, time, if it doesn't kill the deal, it may wound it.
Well, right.
And and so you have to, the preparation is key, plus the better you look to a buyer, the smoother the deal will go, but there are also some, deal terms that will improve if you really look like you're buttoned up, right? There are a lot of opportunities out there for buyers, and so if one company looks better than another in a market, they're going to gravitate to the one they think they can get done, faster with lower risk. So the things, things that we uncover when we do diligence, either sell side or buy side, is particularly troublesome in the cannabis space when you have licenses weren't properly transferred, entities are not owned in the through the right chain as they should be. The financials are a bit of a mess, and right, there's no time like the present to clean those up.
Yeah, Joe, you've made this point that MSOs, buyers will oftentimes pay a little premium just to have it be a little bit less messy.
Yeah, so my experience has been, I've certainly bought more assets than I've sold in this industry, and a lot of it is on first impression. A lot of it, especially if we ever get back to a world where it's face-to-face meetings and on-site visits more than doing some Zoom stuff. But seller needs to put themselves in the best position, and that is both financial, that is legal, but that is also making sure the level of your organization comes off professionally, and that you're a person that somebody wants to engage in a long transaction with. We looked at certainly the overall expense of a transaction, both cash and stock, and what that mix is, the time it's going to take to get a transaction done, the risk associated with the transaction, and then the potential upside of that transaction, and where does that go in the interim. So as a seller, making sure you understand if a buyer maybe is big into the brand side of the business, and you have some brands that you feel are really additive to their portfolio, making sure you highlight that in a professional pitch deck. And but if they're not brand focused and they're really buying you for a limited license market, your true cash flow, focus your energy on those things that are really going to make it look and appear to the buyer that this is the right transaction for them from the get-go. It's not going to be too difficult to get across the finish line. It's going to be something that's very additive to their business. So when they're going back, it's very seldom one decision maker. That information is then going to a board, and this whole process, especially with a private seller selling to a publicly traded company, there's a lot of people who are signing off on transactions these days. So making sure they can articulate why this is the right transaction and how it highlights and fits into that buyer's portfolio is really important, and something I can't overstate enough.
Yeah, and one other thing to add is, I think this industry, like no other, having, professional advisors who know the industry, because there are so many traps for the unwary, in terms of structuring and executing on the transaction, that if you don't have experience and you do it wrong, it's going to cause, major headaches, and maybe the buyer will pick it up soon enough to correct it, but maybe they won't, and you try to get the closing and it all falls apart. Particularly on, involving license transfers. A number of situations where we've seen where, they've lost count of how many licenses they have, and they actually are exceeding the limit, or they try to do it in a structure that just doesn't work, because the local transfers is surprisingly high, and it all goes back to not having, professionals, who know what they're doing, and and that's, and then making sure you have an accounting firm that understands 280E to make sure that they were properly accounted for all this stuff. Is a whole nother can.
Yeah, adding on to that, Mike, one of the things that we see quite often are aggressive 280E positions. And while that's maybe okay, you may be able to get away with it as a small private company, our MSO clients don't want to see super aggressive 280E positions because they need to follow the rules. They're under a lot of scrutiny. And so it's not uncommon for us to enter a deal where we see, all sorts of tricks being played to try and mitigate the 280 impact. And when we get done with it, we are calculating some pretty significant exposures that then the buyers and sellers need to figure out how to account for in a transaction. And it just results in another pause in a process that slows things down.
Yeah. Well, there's obviously a lot of complexities associated with trading these assets, and Joe has educated me that these don't close with nearly the same percentage success rate as they do in regular industries. Unfortunately, he did that long after I had already started an advisory firm focused on advising. But hopefully some of this, preparing beforehand, doing the accounting work beforehand, doing the legal work beforehand, mapping the industry, thinking about who the buyers are, positioning yourself, positioning your strengths to those buyers' desires will allow these things to move faster and start to complete with a higher success rate. So with
Steve,
that,
well, I mean, and that point, Steve, and I think, in the 4 years that I've been heavily involved in the industry, the professionalism has increased significantly. So I would expect, as this industry continues to march forth, that the percentage of deals that close will continue to increase, just because of the both at the C-suite level and as well as sort of at the professional services level, whether it's lawyers, accountants, or investment bankers. The quality coming to the table, will make a lot of those issues heretofore disappear.
well, from your mouth to God's ears. So let's say these things do start getting done. Obviously, transactions are getting done. Let's talk a little bit to our audience about life after close. Joe, you've made the point very clear. You're going to be taking consideration in the form of stock or earnout that is going to be contingent on future events. You're not riding off into the sunset with all of your enterprise value. So let's just talk about what that really means and how sellers should be thinking about this. Should they be analyzing the prospective buyer's stock to think about what they're really getting into? And you talk about lockups, which I'm not sure people fully understand. Maybe Joe, could you talk a little bit about some of the implications there?
Yeah, I mean, any seller should, especially as you get into a process with a potential buyer, you need to underwrite that company as well. And you need to underwrite and understand what they're all about, what their vision is, what their cash positions are, and really make sure it's something, in my experience, you're going to be part of that organization for an extended period of time. If you're selling your company for $50 million, as I said before, maybe 25%, maybe 25 million is cash, 25 million stock, but that stock also isn't going to get released that very next day. There's going to be extended lockup periods that are typically longer than in other industries. You've got a illiquid market that a lot of the publicly traded companies sit on at the CSE. They're not going to be trading multiple million shares on a daily basis. It's certainly increasing the amount of liquidity, but it's not to the extent of a New York Stock Exchange or a NASDAQ listed company. So you're going to have tranches that will release over 12, 24, 36, or 48 months. It's a very long time. So positioning your asset that it's great and everything looks good, but you're going to be a big part of that bigger company. So making sure that company, when they close on the transaction, the business looks the same as it does or better on the day you close than the day you sign that deal. Gone are the days of signing a piece of paper and getting across the finish line and walking away saying, oh, thank God I got out of there before the house fell down. That's not what cannabis.
That's always so easy, right, Joe? I mean, these disclosures, some of these public company disclosures are very difficult to understand. The actual dilution of the various options and warrants that they have out there are very difficult to get behind. Is this something you advise sellers on, or help them think through? How do you really get behind what you're taking?
Yeah, I mean, you certainly need professionals on there. That's not my area of expertise. I'm the go get them, hard charging, get the business up and running, and then turn it over to professionals like you guys to make sure all the T's are crossed and I's are dotted, and that the deals get across the finish line. But buyers need to be, or sellers need to be prepared to be part of this transaction, whether it's an operational role or not. They're not riding off into the sunset. They need to make sure that their employees understand what's going on, that they're going to be a part of a different organization. And I think the other panelists will get into some of that, but it's really important that this isn't just a walk away situation. If you're fire selling, that's one thing where it's a cash transaction, but count on getting a very depressed price if that's what you're looking for. It doesn't, you can't maximize your top line and also maximize your terms in this space. It's just too new and there's too few buyers out there for things like that.
Yeah.
I was going to say particularly from the buy side, right? If the management team that you're acquiring is going to be critical to your success, then you really need to make sure that either, through their advisors or through, your advisors, they understand what they're getting and what the value is and what the risks are. Because you don't, right? If they're a key component, you don't want them to be really unhappy down the road because, whatever then you've given away, if they walk out the door, it goes with them, in part. Obviously you have the company, but if there's critical knowledge that's in their brain and you need them, to really fulfill the business plan, you sort of want them to be happy. And if they think they were taken advantage of or lied to, or things were so complicated that they didn't understand it, that's not going to serve anybody well.
Yeah, adding to what Joe and Michael had said, outside of cannabis industry, there's this concept that we see quite often in private companies, but more often in public companies, is this notion of doing reverse due diligence, right? So if you're going to be part of a large organization, doing what the buyer is going to do to you, it's not uncommon for sellers in those situations to do the reverse, to know who they're going to be getting into bed with, but also understanding the valuation of that business, particularly if they're going to be purchased in stock and understanding what they're signing up for. It's not something we've really seen yet within the cannabis industry, but we think and hope as it matures that this concept will be employed. I think it's critically important as a seller, particularly if you're going to, kind of sign up and hitch your wagon to, another larger organization and an MSO, for example.
Well, and you have to understand, right? They're saying, we're going to give you, $10 million worth of stock. What does that really mean? How are they revalued? Right? You can't take it purely on faith that when they say, we're worth, $400 million. It's like, where did that come from? Where's your last valuation report? Things like that to make sure you're getting what you think you're getting.
Yeah, absolutely. And Greg, while we're on the topic of non-cash consideration, I note that there are a lot of earnouts, it seems, in these transactions. Earnouts kind of have gone away for years in more mature industries due to the complexities associated with taking contingent consideration when you've given up control of the asset. But are you seeing this as a pretty regular occurrence, and what should the seller be thinking about with respect to earnouts?
Yeah, so I wouldn't say it's like a regular occurrence, but we're seeing them a bit more than we had, say, a couple of years ago, where some of these, structures that we'd seen outside of the cannabis industry entering cannabis, and partly I think because of uncertainty around, valuations, a lot of which are built on, projections or expectations around, dispensaries coming online and things that are, somewhat unknown in the future. And so, as a seller, I think you want to think about, the certainty of you being able to achieve that. So certainly short earnout periods, you don't want them to go, say, beyond a year or so. And then maybe not having so much of the purchase price, maybe a smaller percentage built into kind of an earnout.
Yeah, that's helpful. And as a correlated issue, Michael, we're going to be wrapping up here pretty soon. So if anyone in the audience has questions, please feel free to submit them. But with respect to escrows, Michael, and post-closing liabilities and indemnification thereof, is there anything that is unique to the cannabis sector that needs to be considered?
Well, I think the big thing, right, certainly sort of in the non-cannabis middle market world, rep and warranty insurance, is almost universal. And that takes, for the people on the phone who know what that is, essentially you can essentially buy insurance that covers any potential, breaches of the reps and warranties that you've made in your agreement, which is essentially driven, escrows to, down to like 1 or 2%. It doesn't exist yet in the cannabis market. So we are, back to the, the glory days of, escrows and holdbacks, and, sort of given the nature of the business and sensitivities to certain issues, we're seeing, higher than normal, holdbacks and escrows, and then, certain, and more carve outs, particularly in the tax world, because there's always, 280E concern, particularly if, the seller took aggressive position. So it's sort of back to the, the good old days on steroids.
Yeah, I think one of the things I would add is, if you look at some of the recent transactions in Pennsylvania, there are some significant earnout potentials, as you get into some of these bigger transactions. And as a buyer of some of these companies over the years, I want to tie the seller to what they're telling me is so easy to accomplish if they just had a little bit more money. And you're happy to pay it as a buyer. You hope that all the projections that the bankers put on a piece of paper in front of you get realized, because that's what you're underwriting against. So tying people to some of the maybe less financial performance than you otherwise would see in other industries, and more about events of, if we get this store open that you said all of these things are lined up in the municipality, and the mayor and all these things, that when those events get across the finish line, you're happy to pay out and release some of the capital that's tied up. And it's something that will help a seller maximize some dollars if they introduce that concept. I do believe it. You also need good representation to make sure that if you do achieve those goals as a seller, that you do get that capital released and that money sits. No buyer wants to put that money in an escrow either. That's the other side of that coin. So making sure you're well aware of how you do achieve that money in those earnouts is something that allows somebody to maybe maximize some additional compensation.
Yeah, and I think the one other thing that's a little different in this industry, obviously, is the the regulatory regime, and you have the medical use, adult use market, and given the the trends that seem to be developing, where more and more states, either by referendum or by legislation, are moving from purely medical to medical and adult, that opens up a large market. And so if you are doing a deal before that happens, if there's any feeling it's going to happen in the foreseeable future, sellers are going to want the benefit of that. And the only way buyers are willing to do that is in some form of earnout, as when and if it happens and it's implemented, fast enough, and so sales start to hit within a certain measurable period of time. So I would say if there are transactions that happen in New Jersey in the next 6 to 9 months, or 6 to 9 to 12 months, whatever you think it's going to take to get New Jersey online adult use, you're going to see earnouts in those structures, because nobody sort of knows how long it's going to take and what the impact's going to be.
Yeah, we talked about some of the why things may not happen in this space. Recognizing who the regulatory regime is really important too. We've had transactions where the regulators kick back a transaction because it contemplated the shift from medical to adult use, and you're submitting this transfer of control, and it's quasi contingent upon recreational occurring. A Department of Health isn't too keen on hearing somebody talk about the future legislative changes. So recognizing that there's a lot of nuances with the various regulatory regimes that are out there. And again, professionals around you to make sure you put yourself in the best position to get these transactions across the finish line.
Absolutely, that's a great point. And guys, listen, I think we've covered most of the audience's questions, but one last one that's for Joe that I think is interesting and probably a good way to wrap it up is, obviously you've been involved in a lot more transactions in this industry than the average Joe, and you're also a student of the industry and one of the very early pioneers. So what do you, as a seller, what? You've seen ones go good, you've seen ones go bad. What are there, just a handful of bits of wisdom that you could advise a seller on what to be particularly wary of for why these things ultimately, even if they successfully complete something, it's not considered successful after the fact, or they don't complete? What?
Yeah, everybody gets into these transactions with the best intentions, the buyers and the sellers. But what you need to recognize about cannabis is timing is incredibly important. And to speak directly to some of the potential sellers out there, right now, it is a phenomenal time in the cannabis industry. Capital is going to be coming into this industry in a more material way than we've seen in the past. Certainly with the change on the executive branch, you're potentially going to see some coal type memo or decriminalization or things that are going to excite the industry to start putting money into this space. So good timing is ultimately when these deals get done. And I think the timing now is fantastic. You're going to see companies with a desire to go public, as I mentioned before, in Q1, Q2. I think you're going to see a good influx of capital, but it's not going to go to the underdeveloped asset. It's going to be a top-down capital model where that money is going to flow into the bigger organizations who have a proven track record on real execution and are starting to achieve operational scale. So if you're contemplating selling, you need to make sure the capital is in that industry to be there to deploy against what you're selling. And I really think it's a great time for people to really start to consider some of this opportunity that's going to come their way in the very short term. You also potentially have more licenses come online. You know, as Michael mentioned, as maybe a market goes from medical to adult use, like in New Jersey, you're going to see another round of licenses open, and you don't know when that store they're able to open in a slightly better location than your store. That's going to devalue your asset. So, you know, cannabis is certainly on a up and to the right graph right now, but there are things that will disrupt individual assets along the way.
All right. Well, Greg, Michael, Joe, I can't thank you enough for doing this. I hope, thank you to our audience for participating. I hope people found it informative. I certainly did. And we'll do it again sometime, I hope.
Absolutely. Thanks
Thank
for
you.
having us.
Steve.
Thank you.
Appreciate it.
Right.
Take
Thanks,
care,
Bye-bye.
everyone.
I
Bye-bye.
got it. Great work.
Bye.